The last 5 weeks have really been dramatic. It's time to take a look at the real estate market here again in Milwaukee and in Ozaukee County. It's been about a month since I've recorded the last video, pretty much a week into this COVID-19 crisis. And we did not have that much data at the time. It was not easy to predict what's going to happen. We have a lot more data now, which I would like to share with you. And I think you will be as surprised as I was looking at what the actual impact is of COVID-19 on the real estate market. So before we look any further, here's just a quick summary from the March results here according to MLS. And the main takeaway here is that, and keep in mind, the second half of March was already impacted by the coronavirus. So we have seen homes just listed, new listing inventory, going down by 4.5%. We have seen overall inventory go down by 2.5%. So a year ago, you heard me talking about low inventory. Well, we're even lower now. And at the same time, we're seeing a 7.2% increase in home sales. So that's basically the theme that we have right now. And if we go more into details here, you can see the showing traffic, showing time is tracking that very, very accurately for Wisconsin. And we have a record here of every single showing that is being held. And you can see the orange line is the current year 2020 showing activity. And you can see, I think this is where I recorded the last video about halfway through March when we started, showings drop like a knife. And it was not quite clear where things would go. So we bottomed out here about the end of March. We had the Easter weekend, and things are actually coming up here again. And if you compare it with the previous year, 2019 in blue here, you can see the dip from the Easter weekend and from spring break. So we don't have that much of a gap here anymore. And a good portion of the difference between those two might stem from virtual showings, because those are literally exploding. We're seeing a lot more virtual showings. And I know it from my own experience. We have every listing that we have currently has a virtual 3D tour. And my experience is then that when buyers call me, they're a lot more prepared and they spend a lot more time online looking at the pictures and also looking at the 3D video. We're currently also posting pictures of the basement, pictures of the attic, things that you normally would not see in a listing. But we're doing this right now because people want to do as much as possible on a virtual basis and want to see the entire house without having to physically go there. So, but, overall, you can say that, buyers have been very restless and they've held back for a while, but they're out in force and looking to find a property, especially in the lower to medium price points under 350, and then even 350 to 700 is fairly active. Different story over 700. So what's going on with new listings? You can see here in March, inventory per week started, or new listings per week started dropping off. We used to see an average of 615. Now we're down to about 462, at about 25% decline. And the market feels very much like December or January, very low inventory, but buyers are coming out and are very, very keen on finding a good property for them. When we look at pricing, and this is a question that I get a lot, are prices coming down? And I think it's, economics 101, supply and demand. And, from that perspective, it shouldn't come as a surprise. We see median price on existing inventory go up 3.2%. And I think what's even more interesting is inventory that goes under contract is up 4.6%. So that is, those are accepted offers, and those are typically nicer and higher priced properties. Every single deal that I have been involved in the last 7 days or 2 weeks has been competitive with multiple offers. So when we look on a national level, here's what we can see on the seller side. Seller activity index is quite low. Wisconsin here is on the weak side, and it may not surprise you when I flip over here to buyer traffic, you can see quite the opposite. So what's happening in Milwaukee is happening basically on a national level, and that is what keeps pushing up pricing despite the situation that we have currently going on. So I want to take a moment to acknowledge, what's going on here. The last weeks have been very, very dramatic, and I don't want you to get the feeling that, this is, that I'm ignoring this, so this is not happening. It's, I hope that the stimulus checks are coming out this week. So a lot of people desperately need them. You all have seen on the news what's going on with food banks for small businesses. Hopefully the PPP and EIDL programs will be out and will be funding those small places because they desperately need it. So this is happening. And the point that you can see here from the data is, despite of all this, what's going on, extremely dramatic, we are still seeing a very more than robust housing market, price-wise even going up, which is, I would say, quite unexpected. Looking at the U.S. employment, you can see here that, sharp spike in unemployment applications. I think meanwhile we're up to, I believe I heard this morning, 22 million. So that's an insane number. And, I feel sorry for all these people that don't know where the next paycheck is coming from. So hopefully they'll be taken care of with the CARE program. But when you look into the breakdown, I think that is very interesting. This is provided by the Bureau of Labor Statistics, and you can see here that people that have been laid off, 60% of them come from restaurants and bars. So it's very conceivable to me that as soon as we start reopening and restaurants and bars eventually get online again, that they will hire back the staff that they just laid off, because they need people to man the kitchen and run the bar and serve drinks and whatnot. So I think a large portion of these will go back into the workforce relatively quickly, I hope at least. If you look at the remaining balance here, construction workers, same thing. People want to finish their construction projects. They will go back as quickly as possible. Healthcare office workers, childcare, daycare, temporary help, retail, all the stores that are currently being closed. As soon as they open up again, they need people to be there. So the economy by itself was doing very well. We basically just hit the pause button, and you can hear accommodation industry, so hotels, a lot of them will be hired very, very quickly. Maybe not all of them. Goldman Sachs seems to have at least that idea that some of the unemployment will spill over into 2021, but they're predicting it further to go down in 22 and 23. So it will not all be resolved very quickly. If we've recovered from that, there will be some lingering effects. And I think we all have to acknowledge that and also plan for that. Here you can see the four major banks, Goldman Sachs, JP Morgan, Morgan Stanley, and Wells Fargo, and their forecast for the GDP 2020. Morgan Stanley is the most pessimistic with 38% decrease here in the second quarter, but they're also the most optimistic for the third quarter and the fourth quarter with the increases. So if they are correct, we are going to be looking at a V-shaped recovery. So, after hitting the pause button, we're hitting the play button again. This is a slide that I've shown last month, and I think it's so important that I want to show it again, or maybe you haven't seen it. So in 2008, and you will recall this very well, the real estate market has lost massive value. But if you think back, you will recall that it was a mortgage crisis, a housing crisis. We had too many loans, too many bad loans, and way too much inventory that nobody needed. Sorry, phone call. So, of course, this led to a massive decline in real estate value. When you look back in history, you can see that most other recessions had almost no effect on the real estate market if the market didn't even go up. Real estate is considered a hard asset, and if the stock market is crashing, a lot of that money is going into hard assets like gold and real estate. So 1980, we had very high unemployment rates, 8% unemployment. Mortgage interest rates were 16, 17%. Home values went up at that time. 81, the same thing. 91, we've seen some declines, but quite frankly, 2% is not that bad. And in 2000, 2001, we've seen 6.6%, in light of the dot-com crash and massive devaluation on the stock market. So the housing market is relatively separated from the state of the economy and from the state of Wall Street. And I think this explains a little bit why we're seeing what we're seeing right now, that despite the desperation that we have in, that many people feel in their bank account and being laid off and unemployed and massive amount of uncertainty that we have, and that everybody feels on an emotional level, is that the housing market is as robust as it looks like. Looking at equity, an interesting statistic that I found here, over half of the Americans have either owned a home free and clear, that's about a third, and the rest of them has at least 50% equity, so very comfortable situation. Cost of home ownership is very low compared to 2006 to today. It's a lot cheaper to buy and own a home today with the interest rate and the change that we have seen, the small changes that we've seen in income. And what the millennials are looking at, and I'm waiting for my next slide here, what the millennials are looking at, it's the, millennials have been said they're not going to go into the home buyers market, and that is changing now. I'm seeing millennials entering the market, and I think the reason is here. They're looking at, how much they're spending on rent versus how much it would cost buying a home. And, they say, well, we got to change that. We got to get out of rent and we got to buy a home, just, from a financial point of view. So that is a massive group of people that is now coming into the housing market, and they're buying up inventory, in particular, listings below $350,000. Mortgage rates are low and are projected to remain low. We've seen a lot of refinancing, and they'll probably continue. But overall, depending on whose forecast you believe the most, we will, they all agree that we're going to see low rates. This might be a surprise because these are FICO scores of people who purchased homes, and you can see that you do not need an excellent credit to purchase a home. 50% of all home purchases are under 750 credit score. A lot of them actually in the 600 range. So if you look at these two bars, maybe you know somebody who has been thinking about or should really be buying their first home and stop renting, and they're worried about their credit score. They should see this and take a look, because if they're somewhere in here, they're basically good to go. This is an updated forecast for appreciation. It emotionally doesn't feel right, because with everything that we've going on with unemployment and the dramatic situations that people experience on an individual level, why do we think that home prices are going up? But it is supply and demand, and we're seeing it on a local level. You've seen the stats, and this is what CoreLogic believes the year of 2020 will look like. So Wisconsin plus 4.3% is the current forecast. So what's the bottom line? The real estate market is surprisingly unchanged, unfazed from everything that's going on with COVID-19. If anything, we have seen an inventory squeeze during this time. The sellers are more reluctant. They don't want to bring a lot of people through their houses, which is very understandable. So that's the reason why every single of our listings has a virtual 3D tour where you can navigate through the house on your own pace and look at everything. We're including attics and basements and everything, which typically nobody does. But I think at this time it just makes sense. Sellers are holding back. Buyers are very restless and very serious. So they have slowed down for 2 or 3 weeks, but we can see the phones ringing more, and people are getting back into buying mode and showing mode. I can tell from personal experience that people spend a lot more time qualifying a listing on their computer screen before they actually give me a call to go out and take a look at the listing physically. Good news is we're expecting more inventory to come in June and July, depending on when we open up again, because a lot of people that are holding back right now and quite frankly missing the opportunity that there is now on the seller side, they're planning on bringing their house on the market in June or July. So I'll be back with an update in about 4 weeks. Thank you very much for watching, and Stay safe and stay healthy, and I'll see you in about a month.